Welcome to The Explainer. Today, we're opening up the detective's toolkits to uncover the real financial truth behind public companies. Look, every piece of information you need to know whether a company is thriving or quietly falling apart behind the scenes is public, it's organized, and it is waiting right there for you. You just need to know how to bypass the PR spin to actually see it. In this explainer, I'm going to show you that understanding a company's financial truth really doesn't require an accounting degree. It actually takes less than 10 minutes once you know exactly what to look for. So let's dive right in.
There's a critical gap between what modern retail investors do and what they could do, and that gap is exactly where bad decisions live. Think about it. Most investors obsess over these flashy headlines about earnings beats. They stare at price charts looking for some hidden pattern, or they hang on every single word management says during an earnings call. But what they often ignore is the actual math. They rarely check the SEC documents where the indisputable truth is hiding. The numbers behind the words are what actually support or destroy the story being told. And that gap in knowledge, that is exactly where bad decisions happen.
Here is our roadmap for today. We'll look at the education gap, the golden equation, dive into assets, liabilities, and equity, and then wrap up with a practical playbook. Let's break this down.
Section 1. The education gap and our missing financial skills. Look, if looking at financial statements intimidates you, you are absolutely not alone. They definitely didn't teach us how to read a balance sheet in high school, and rarely even in college, unless you happen to major in finance. But honestly, it's the ultimate lie detector in the business world.
To really grasp the balance sheet, you have to know how it's completely different from the other financial statements. So a company publishes three core documents: the income statement and the cash flow statement. Those act like a movie. They show you the action, revenue, profit, and cash moving in and out over a period of time, like a quarter or a whole year. But the balance sheet is a photograph. It captures a frozen moment in time, usually the last day of a quarter. It doesn't show you the action. It shows you the exact state of the company on that specific single day. It tells you exactly what they own, what they owe, and what they get to keep.
Moving to Section 2, the golden equation. This is the structural foundation of that financial photograph. It's a rule that never, ever changes, whether you're looking at a local bakery or a trillion-dollar tech giant.
Assets equal liabilities plus equity. It's that simple. Everything on the left side of this equation, the assets, is what the company actually owns. Everything on the right side explains who actually has a claim to those assets. So the totally crucial point here is the strict hierarchy of this equation. When things go wrong, creditors get paid first through the liabilities. Shareholders, well, they only get the leftovers through the equity. Understanding this hierarchy matters enormously when a business hits rough waters.
Section 3, assets, or what the company owns. Starting on the left side of the ledger, this is honestly the most intuitive section of the balance sheet because it simply lists everything the company owns or is owed by someone else.
Now, assets are broken down into two very distinct time frames: current and non-current. On the left side here, we have current assets. These are near-term resources. Think of things that will be converted to cash within the next 12 months. So this includes the actual cash on hand, inventory waiting to be sold, and accounts receivable, which is really just a fancy term for money customers owe the company but haven't paid quite yet. On the right, we have non-current assets. These are the long-term holdings, like property, heavy equipment, factories, and patents. You'll also see a line item here called goodwill. Goodwill simply represents the premium a company paid above book value when they went out and acquired another business.
When you're scanning those assets, the absolute first thing you must look at is the cash position. How much cash does this company actually have sitting in the bank right now? A company sitting on $10 billion is in a fundamentally different universe than a competitor with $200 million, even if they have the exact same revenue. Why? Because cash is optionality. It dictates whether a company can survive an economic downturn, acquire a rival, or weather a really terrible quarter without being forced to borrow expensive debt, or worse, dilute its shareholders by issuing more stock. And this dynamic reveals a major red flag you've always got to look out for. If you see that revenue is growing nicely, but accounts receivable is growing much, much faster, alarm bells should be ringing. It means they're booking sales, but the customers aren't actually paying them yet. Or, even worse, the company is aggressively recognizing revenue way too early just to make the quarter look good. Either way, it demands a much closer look on your part.
Section 4, liabilities, what the company owes. Jumping over to the right side of the ledger, if assets are about what you have, liabilities are the burdens you carry. And honestly, this is where the real story of financial risk and corporate danger lives.
Let's see how this builds upon our previous table. Just like assets, liabilities are split up by time.
Current liabilities are immediate obligations due within the next 12 months, things like accounts payable to suppliers, short-term debt, and accrued expenses. Non-current liabilities are the longer-term burdens. Think pension obligations and, most critically, long-term debt. For the vast majority of companies you'll ever analyze, long-term debt is without a doubt the single most important number in this entire section.
So, how do we actually know if a company has too much debt? We use a crucial leverage ratio called debt to EBITDA. You just take the total debt and divide it by the company's annual operating profit, often called EBITDA, which just stands for earnings before interest, taxes, depreciation, and amortization. This simple math tells you roughly how many years of pure operating profit it would take to completely pay off all their debt. It shows you if a company's debt load is structurally supported by what it actually earns in the real world.
Let's look at a quick example. Say a company has $10 billion in debt and $2 billion in operating profit. That gives them a 5x leverage ratio. So is that bad? Well, context really matters here. If this is a highly predictable, stable software or utility business, 5x might be perfectly manageable. No big deal. But if this is a cyclical business in a volatile sector, like an airline or a commodity miner, a 5x leverage ratio is highly risky. As a general rule of thumb, anything above 4 or 5 times definitely deserves intense scrutiny.
Which brings us to Section 5, Equity, the residual value. After you take everything the company owns and subtract everything the company owes, equity is what's left over. It's the residual value. This is the theoretical value that actually belongs to you, the shareholder. When you look at the equity section, you're going to see a few common line items. Paid-in capital is the actual money the company raised by selling stock to the public. Retained earnings is exactly what it sounds like. It's the cumulative profit the company has generated over its entire lifetime and kept in the business rather than paying it out to investors as dividends. Finally, you might see treasury stock, which is a negative line item representing shares the company's bought back and retired. What you really want to watch here is the trend in retained earnings. Growing retained earnings, that is the ultimate fingerprint of a healthy compounding business over time.
Now, sometimes you might look at a balance sheet and see that total liabilities actually exceed total assets, which creates negative equity. Your first instinct might be full-blown panic, but don't panic just yet. It's not automatically fatal. You just need to look at why it's negative. Intentional negative equity happens when a highly profitable company aggressively buys back its own stock, which pulls down the equity number on paper. Unintentional negative equity, on the other hand, is driven by years of accumulated business losses just bleeding the company dry. It's the exact same mathematical result, but 2 completely different realities. It just demands an explanation.
Finally, Section 6, the playbook, an actionable sequence. Now that we've mapped the anatomy of the balance sheet, it's time to put all of this theory to work on a real company in a rapid-fire sequence.
Here is your explicit 4-step process to separate the genuinely healthy businesses from the ones quietly borrowing just to fake it. Step 1. Check the cash position over the last 4 quarters. Is it growing, is it stable, or is it shrinking? Step 2. Look at total debt and calculate that debt to EBITDA ratio to see how many years of profit it takes to pay it all off. Step 3. Calculate the current ratio. And Step 4. Analyze the overall equity trend over time. Is the company actually building value for shareholders, or are they slowly eroding it?
Let's quickly expand on Step 3, the current ratio, because it is incredibly simple but super powerful. Just divide current assets by current liabilities. If the number is above 1, it means the company has enough near-term resources to cover its near-term obligations. We like that. But if it's below 1, the company might be facing an immediate liquidity crisis and could require new financing literally just to keep the lights on.
Ultimately, what you need to remember is this. The balance sheet doesn't explicitly tell you to hit the buy button on a stock. Rather, it acts as a reality check. It tells you if the shiny story management is feeding you on TV is structurally supported by the actual financial foundation of the business. Look, a CEO can say the company is stronger than ever, but the balance sheet cannot lie in the same way. Numbers can be slightly manipulated at the margins, sure, but the fundamental relationship between assets and liabilities will always, eventually, expose what those slick press releases try to hide.
So I'm going to leave you with this question to ask yourself the next time you look at your portfolio. Does the balance sheet actually support the story management is telling you? I challenge you to pull up the SEC filings for your absolute favorite stock today, run it through our 4-step playbook, and uncover the financial truth for yourself. Thanks so much for joining me on this explainer, and happy sleuthing.